Hey Trade Pros, welcome back to our channel. And it's an amazing time to come back because we are in a specific market condition with increased volatility that's got everyone scrambling and massive fear coming in. Everyone's looking for a new strategy, they're blaming their strategy, they're looking for the holy grail to trade volatile markets, and they have to trade non-volatile markets, and everything's becoming a mess. Not me, however. I'm going through this chaos with the same trading strategy that I've been trading this whole time, and I'm going to explain to you guys how and why. And it's not specifically the system, it's not specifically your indicators, but it's something else that's drastically important, and it's who you are as a trader. So throughout this video, we're going to be breaking down why I'm using the same core system, how I'm doing it regardless of the volatility, and what psychological shifts I've taken to better prepare myself for this volatility. There's a slew of different things that traders do in terms of panic, right? They panic when market conditions change, and they panic when their strategy isn't working as well as it might have before. So this is a perfect time to talk about something like this because the volatility has drastically increased, and I have made some changes to the way that I trade, but my core system and strategy have stayed the same. Now, traders, when they see these kind of market conditions change and you have an increase in volatility, increase in VIX, you see them changing their strategy. They panic tweak their strategy, which makes them kind of look at things from a very different perspective from what they're used to. For example, when you have these massive moves and these volatile swings, they might try breakout strategies when they're not fully used to something like that, or they might even try pullback strategies when their strategy doesn't really tell them to do something like that. They also might add more indicators. They think more information is going to really help them understand how these moves actually happen and what the expected stop point of those moves may be, the reversal, the continuation, whatever it is. They add a lot more information, which can honestly blind their vision, and I think that's generally the case in trading. The more information that you have isn't necessarily going to produce better results. They might even just completely abandon things. They go back to YouTube, they start strategy hopping, they look for new mentors, they look for new groups, they look for new traders to follow that might be killing it in these specific market conditions and completely abandon what they've been doing that's been working so far. But the problem isn't necessarily the strategy or the system. Now, some strategies might need a bit tweaking in these conditions, and I'm going to show you not only some trades that we took over the last few days in an instance of volatility and one of slower market movement, but also we're going to be breaking down how I've kind of changed bits and pieces of the strategy itself. And it's not how I approach the market or how I enter, how I exit. It's mainly me as a trader and some of the risk management tools that I need to appropriate in these more volatile conditions. So I'm not saying the problem is the strategy here, but a lot of people take back-to-back losses. They may jump in too quickly and then they think that, okay, clearly what I'm doing is not going to work in these conditions. Let's completely abandon that and start from fresh realistically. So like I said, the problem isn't fully the strategy itself. It's strategy hopping, right? That turns into an identity crisis. Am I a good trader? Am I able to trade these markets? Do I have to wait for lower volatility, or do I have to completely adapt to them? So if your confidence is tied to the market conditions, you don't necessarily have a system. You have more of a crutch. So most traders don't trust their strategy because they don't trust themselves. And I think that to fully trust a strategy and trade a strategy regardless of the condition, you have to know it in and out. So you have to know when it fails, when it does well, and adjust some of those criteria to make it a smooth transition when volatility increases. So realistically, when I'm looking at my system, my strategy, you guys know that I trade primarily on auction market theory with the use of volume profiles. So that's going to be my biggest tool, using these volume profiles and understanding how the auctions work around them. The beauty about this system and strategy is that regardless of the market conditions, one thing stays constant in market movement, and that's going to be volume, right? Volume is going to be present regardless of how fast or how slow the markets move. So if I can stick to the primary rules of auction market theory, right, the system that I've built out, then I have to only make slight tweaks, right? I don't have to completely abandon it and say, oh, I have to trade purely on order flow now, or I have to trade using moving averages, or whatever the case may be, right? It's designed for adaptability without changing its core principles. The only principle that I'm going to change is the risk management that I take into these volatile conditions. So this strategy works because I work on how I, as an operator, go about the markets and the system itself. It's not going to be something that I can use a 3-point stop on the S&P anymore, right? I have to be aware of that. So I can't use maybe a 20-point stop anymore on NASDAQ if the volatility is heavily increased. I look at things like average true range as well as VIX to understand that my risk has to change based on the speed of the markets. So realistically, when I have these more volatile conditions, we might look at the VIX a little more. For instance, right, if the VIX is over 30, then I have to understand that I should expect larger swings in the market. So if the average true range on NASDAQ goes from maybe 100 to like 300, well, I have to understand that, listen, yes, there are massive moves, there's a lot of opportunity, but I have to adjust my stop that's maybe going to be a bit bigger and reducing my position size so that I can get on these moves rather than getting on the move, getting stopped out and looking at it go my direction, which just destroys a trader's confidence and the confidence in their system and their strategy. So when I look at this, it's all about how you as an operator adjust yourself, not fully the strategy, right? There has to be a sense of understanding fully how the strategy works from a risk management perspective, number one, right? The risk management perspective is going to guide you in terms of the appropriate risk that you can take based on stops, based on targets in these fast-moving markets. Maybe I don't fully hold a position to a huge profit, right? Because even if I'm looking at it from NASDAQ's perspective, I'm using a 30-point stop, well, I could probably get like 60, 90, 100 points fairly easily in these markets before it starts turning around. So when I go about my system in a volatile market, I have to understand that there's going to be an emotional aspect about it, right? When you see these markets swinging back and forth, a lot of people get FOMO, right? They want to jump in the move. They want to really catch those larger swings, and they want to be on a lot of them because they see opportunity left, right, and center throughout the day. One of the things that I've adjusted from that perspective is understanding that in the first 20 to 30 minutes of the market, there's going to be a lot of volume that comes in and there's going to be pretty wild swings. Using that time to gather information about who's generally in control allows me to slow the market down, because you can't fully slow the market down unless you slow yourself down. So when these things start chopping around, getting jumpy, people want to act. They want to jump in, and it may not be at the area that they trade, and they may completely abandon their strategy because they're trading movement instead of the system that they have. So if I can just subdue my emotions, that slows things down internally for me, it can theoretically slow the market down, so I'm looking at the precise location as to where I do want to trade. So when I look at this, I want to really even like verbatim self-talk that I have this system and I'm waiting for XYZ area to trade based on my auction so that I can take the trade there. It shouldn't affect me that the market might swing 100 points and then I'm not on the trade. One of the best things to ask yourself is, okay, if I miss this move, is it to my system and my strategy, or is it just a market move that happened and I feel bad because I'm not on it? Because if I can miss a move that doesn't completely coincide with the strategy that I'm trying to trade, well, that's fine, right? It shouldn't really matter to me. If I miss a move that makes sense based on my strategy, I can review that, but I shouldn't have an emotional attachment realistically to that move because I missed it because maybe it was too volatile or it ran too fast. Another aspect is that you have to understand that since markets swing a lot, right, and there's going to be a lot more movement and volatility, that you're going to have a lot more opportunity. And the trades that you want to take based on your plan are most likely going to come to fruition throughout the day. It's just a matter of waiting for those higher probability moves to come to you rather than emotionally jumping in the market and getting cut up in the first 10 to 15 minutes and then not having any bullets for when the trades actually come. It becomes this sort of loop realistically, right? You look at the market, you see massive moves, you have FOMO, you're kind of scared that you're missing the moves. You take a few bad trades, right? You change your strategy or your system based on reaction instead of what it is that you should be doing. And then that just continues over and over and over again, right? That instills kind of a pushback on trying to trade volatility and waiting for markets to kind of die out. By the time that you transition yourself into more of a volatile market and volatile situation, you may have adapted a certain way, and then when markets change back down to lower volatility, you're going to have to adapt back into that kind of move, because even in these fairly volatile markets, there are going to be days like today where volatility has dropped off significantly. And if I've completely changed the way that I'm trading this and my strategy, instead of changing my risk or changing the way that I enter, then I'm going to have a lot more difficulty going back and forth from larger swings to smaller swings and lower volatility to higher volatility, which just completely ruins all the work that I've been doing trying to create this system that is realistically based on auction market theory. So I'm not trying to change my system. I'm trying to trade that system with a few different factors that volatility brings in. So number one, I understand that there's going to be larger moves. Number two, I understand that some of those moves can get very jumpy off the open. Number three, I have to understand that I need to adjust my risk in relation to the volatility. So I might have slightly wider stops with decreased size. And then number four, right, there's going to be opportunity all throughout. So as long as I wait for the key criteria, then I'm going to have a much better chance in surviving these market conditions and catching these monstrous moves. So you don't have to change everything about the system in these conditions, right? You get emotionally attached to these moves and opportunities that really shake things up. So whether it's a massive move or whether volatility is super dried out, the strategy stays the same, right? Even through COVID, it was the same principle. Markets were dumping 5, 10 limit downs on the overnight session, and things didn't change from that perspective. So what I'm going to do is break down a little the way that I view this market from an auction perspective, show you two different trading days that have maybe a lower volatility type movement and a higher volatility type movement to show you that things don't necessarily change. So first and foremost, right, if we go back to one of the days that was a little jumpier and had these monster moves, whether it's on NASDAQ or the S&P, the NASDAQ, I think, moved probably over 300 points on that day. You'll see that if I'm using my principles with a slightly wider stop, things still make sense. I don't have to get too jumpy. I don't have to completely change the way that I view the market, right? It's all going to be based on how I view the volume profiles as well as auction market theory to give me confidence in the system itself. So if I look at this thing and we're just trading it based on the understanding that, you know what, the market's closed, it doesn't move, I don't have to get super active, I'm just trying to identify a trade plan. If I have a monster distribution over here, there's an area approximately at 150 on the NASDAQ. Right? If I look at this is the overnight, this is Monday's session. If I'm trading Monday's session, I understand that if I'm within this distribution, there is some kind of expectancy for prices to hold and continue higher, right? If I lose this distribution under 150, under 0.80, what happens? I should be a seller in this market. I'm just waiting for pullbacks to come into that space so that I can position myself to look at it from a directional perspective based on auction market theory. So I have this huge balance on the prior overnight, and I'm using this 600-day volume profile here on the right to give me a clear instruction on where I should stand directionally in this market. So if I wait for the open, because it gets very jittery, I'm going to wait the first like even 30 minutes, right? Maybe 20, maybe 40 minutes to get a better understanding of what's going on. So if we take a look at this, this is where the market opens. All right, market opens up here and we're slowly creeping lower. So we're losing the momentum. We're creating lower lows, lower highs. And here's the first spot where maybe a buyer can show up. But I don't really like the price action like this, right? Either pull it back and we can look for some kind of long side, or I just leave it. But again, if I wait 20, 30 minutes, I'm going to gather more information. So we lose this area. What happens? This area getting lost and creating new lows creates an opportunity for me to look for that short side. So if I wait for a few, maybe instances, maybe a few traders to show up, and I'm slowing things down rather than getting emotional and being like, it's in my area, I have to take the trade, otherwise it's going to go 100 points in my direction. If I wait for that information, more than likely I'm going to get at least, right, a few trades throughout the day. I don't have to be on every move, and I don't have to catch these monstrous swings. So generally, when we come back into this region after failing it, as we showed you with this volume profile in these auctions, we have a fantastic trade to the downside here. Even on the other side of things, right? If I look at the profiles a little more intently, I understand, okay, realistically, into under 19,000, I should probably be a little more bearish in this scenario. I understand that close to 18,800 is also an auction bottom that allows me, maybe I can find some kind of support structure from there. The weekly profile has a nice balance low at that point too. So even if I miss a short side, I understand even where I can get on the long side. So again, it's just about the system and strategy. I'm not changing anything because of the volatility. This is the first retest. I think a little more difficult to catch, but that's okay. We come down into that 18,800. We get a little long side move there. and we can't make a new high. Lower highs continue. It's a part of the strategy, so I don't want to keep buying that area. So when we move back above it, right, maybe I can shoot it on the long side again, and we get this nice little move to the upside swing. So this is a more volatile day. But if we slow it down and we take a look at how today panned out, it's the same principles. I'm not changing anything about how I view this market. So even if we go to the open and we do a little quick trade plan in terms of what's going on, if I look at the overnight from last night, right, in relation to the larger profile, in relation to the weekly profile, what is the information that I can get? So if I'm looking at this, we have the 19,000 over here. We have a close on the ETH that's pretty close to it. We have a double distribution. So technically, at this point of the double distribution, there is support. I want to be long above that 19,000. And honestly, if we do fail into this area, right, the 140, it offers another opportunity to look for that short side swing. So throughout the day, I kind of let this thing go. We get this nice little move off the open. Like I said, in the first 5 minutes, if it comes about, it's a little more difficult because I just want more information. So it comes about, we ultimately fail back down into this area, and we lose the 0.80 on the NASDAQ. So I'm looking at this, we're trying to creep up. So we have two opportunities now. The fact that we made a new daily low off of the 140 area, 150, whatever it is, maybe I can look at it from the perspective of where's the top of the weekly balance at this point, if we can make a lower high from this perspective to continue the downside momentum. So yeah, I could be long from the double distribution, which is at 940-ish, but I can also look at this from 0.80 and say, okay, based on the auctions, we've left a massive auction from the upside. I can wait for that trade to come through. So once it comes through, right, that's my trigger point. Let's see, maybe we can make new lows. But if we can't, right, we stop trying to sell this continuously. So my point being is that, yeah, of course, stationary, it might look a little different because the trades have already played out, they've already moved around, but it's going to be the same principles. I just have to patiently wait for the areas to actually trade and get that kind of information. It's the same thing, right? We lose this 19,000 significantly. What are we doing? We're generally looking for that downside momentum to continue from that spot. You've got also the accumulation of delta, which is a huge factor that has helped me throughout this. Order flow can be very quick in these more volatile markets. So the way that I look at it is, where is there some kind of delta buildup to tell me who's in control? So if I use these auctions and I understand where these massive areas are, and I do my auction analysis based on what's going on, right? When we lose these distributions, for instance, under 19,000, it tells me that the day is starting to flip more bearish. I don't have to jump in on the first move lower. Even if it moves like 70, 80 points in my direction, I can wait for prices to come back into the areas that I care about. And it was a little slower of a day, a little less volatile to present that kind of opportunity for us. So if I'm looking at this, whether it's heavy volatility, whether it's low volatility, things stay the same. It's not going to change based on volatility, right? Because the core principle that does move markets is volume. The only thing that changes is my emotional awareness about the market and a few little shifts like risk management and being a lot more patient, understanding that there is going to be a lot of opportunity in these markets. So if you're constantly switching strategies, the market isn't the problem, realistically. It's the way that you as an operator go into the market and the self-image that you have about you as a trader. So some of the biggest challenges are going to be FOMO. They're going to be over trading in these volatile conditions. And traders really, really get trapped in these cycles that flip them back and forth, which turn into losses and loss of confidence in the strategy. So I don't necessarily think that it's the strategy is the problem. It's the way that you perceive it as an operator. And there's a lot of different things that you can do, right? Really understand your strategy and system, number one. Understand that some things might have to be tweaked. There's going to be a lot of opportunity throughout the day, so you don't have to be on the first moves. You don't have to be super aggressive about things. And you can use, again, the same principles. Maybe you layer in a little more onto the order flow from Delta, for instance, to give you a little more confirmation. You wait for a few more rotations, right? You can slow things down in a fast market by slowing down the way that you perceive that information, really focusing on the plan that you have ahead. So I hope you guys did enjoy this video. We're going to be breaking down more of these and more psychological tips coming your way, and I'll see you guys in the next video.